This is an Uncovered Japan company research report on Central Glass, ticker 4044. Despite the name, the investment story now rests on fluorine-chemistry, semiconductor process gases, the sevoflurane anesthetic, battery electrolytes, and specialty materials, alongside a restructured glass base. We will examine the operating evidence, the balance sheet, and the two questions that decide the valuation. The report's snapshot uses a share price and market data as of June 14, 2026. Forward earnings are valued at 13.8 times. The dividend yield is 4.24%. The equity ratio is 62.5%, and fiscal 2026 return on equity is 7%. This is not a deep distress valuation. The case depends on dependable cash returns, semiconductor material growth, and whether the loss-making electrolyte business can recover. Central Glass began in soda products and glass, but the important capability today is an integrated fluorine platform anchored at Ube. It supplies high-purity gases used in semiconductor etching and cleaning, the active ingredient for sevoflurane anesthetic, lithium battery electrolyte, low global warming potential chemicals, and specialty glass. Long qualification cycles and failure-intolerant applications make this operating know-how harder to replicate than the company name suggests. The falling revenue line is largely deliberate restructuring, not a simple demand collapse. Central Glass exited overseas automotive glass and other low-return operations, reducing revenue from 206.2 billion yen in fiscal 2022 to 144.5 billion in fiscal 2026. Over the same period, the operating margin improved from 3.5% to roughly 6.9%. The company became smaller, but structurally stronger. The segment mix makes the thesis clear. Electronic materials and life and healthcare each earned margins around 15%. Glass is still the largest revenue segment, but after restructuring, it recovered to a positive margin near 4.7%. Energy materials is the open wound, with an operating loss of 3.3 billion yen and a margin near negative 27%. The profitable engines must keep growing while that loss is contained. The durable advantage comes from decades of hydrogen fluoride production and applied chemistry. Semiconductor gases and pharmaceutical ingredients require strict quality control and long qualification cycles, creating sticky customer relationships. The report identifies Central Glass as the world leader in sevoflurane raw material and the supplier to major Asian semiconductor manufacturers through regional ventures. These are process and trust advantages rather than a conventional consumer brand moat. Central Glass now has the strongest displayed equity ratio in the report's peer group at 62.5%. Return on equity normalized to 7% after the distortion from asset sale gains. That balance sheet provides resilience and funds the strategy, but it also raises the hurdle for capital efficiency. A lasting re-rating requires operating improvement and a higher return on the large equity base, not merely more cash accumulation. Operating cash flow increased for 4 consecutive years to a record 26.4 billion yen in fiscal 2026, and free cash flow was 16.4 billion. This funds specialty chemistry investment and shareholder returns. The report also records a 54.4 billion yen tender offer buyback, a share count reduction of roughly 39%, and a 170 yen dividend floor. Operating cash is a cleaner measure than net income, which has been distorted by divestiture charges and asset sale gains. Vision 2030 aims to double group operating profit to 20 billion yen. Semiconductor process gases are the clearer growth engine, supported by advanced logic and high-bandwidth memory demand. The harder assumption is energy materials. Management expects the electrolyte business to move from a large loss toward 5 billion yen of profit by fiscal 2030. The report's base case needs the first engine and meaningful loss reduction. The bull case needs both. At 13.8 times forward earnings and about 7% return on equity, Central Glass sits around the middle of the selected peer group. Its 0.8 times price-to-book ratio is still below some peers, but it is already at the top of the company's own historical range. The market is recognizing the stronger balance sheet and dividend. Further re-rating needs evidence that specialty growth and the electrolyte repair can raise sustainable returns. These scenarios are assumption tests, not price targets or investment advice. From the report's 4,005 yen reference price, the 3-year bear case is roughly 20% lower, the base case about 12% higher, and the bull case about 50% higher. The range reflects 2 unresolved questions: whether energy material losses reverse and whether investors begin to value Central Glass partly as a semiconductor supplier. The dividend floor provides support, but it does not remove execution risk. To conclude, Central Glass is no longer best understood as a commodity glass company. Its stronger case is fluorine-chemistry, record cash generation, a fortress balance sheet, and a high-floor dividend, with AI-semiconductor materials as the clearest growth option. The trade-offs are also visible. Valuation is no longer obviously cheap, and the electrolyte turnaround remains unproven. For the full evidence, assumptions, and source detail, continue with Uncover Japan's free deep dives. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.